How to buy your first home. So first thing you need to do is make sure that obviously your credit score is decent. The banks are actually very lenient on this, believe it or not. So you can actually get an FHA loan for 580, a 580 credit score, but you're going to be paying a ton of interest. What you need to do is you need to make sure that your debt to income ratio is below 45%. This is the biggest thing. And it has to be below 45% after you add the cost of the home. What your debt to income ratio is your monthly debt payments as a percentage of your total income. For example, if you make $5,000 a month, you need to make sure that your debt with the home included is less than around $2,000 a month total. All right. So now let's go into the actual details of how to buy your first home. Honestly, I do recommend working with a real estate agent. You can do it yourself, but it is really not worth it. There's a lot of steps that you might make mistakes on, and you want to have them work for you. They are going to be putting in the legwork, they're going to be doing all the hard work. You just tell them what you're looking for, and a good agent's going to find it for you. If they take forever to get back to you or they get frustrated by you wanting to find the right property, don't work with them. There's plenty of agents that are investor friendly. Bigger Pockets actually has a forum where you can go and you can look at different types of agents in your area. I work with Tony Parker and Asa Eiffel, the Mid City real estate team. They're great. The Parker team. That's who I use. Go out and find yourself a really good agent. That's going to help you in this home buying journey. Next, you need to pinpoint the home that you're looking for. So don't go and buy the biggest home that you can afford, right? So, for example, Mackenzie, my wife and I, whenever we got approved for our home, was actually last year we got approved for our first home. The biggest home or the most expensive home we could buy was worth 230,000. That is the amount that the bank would lend to us with our current debt to income ratio. Remember, your debt to income ratio is the percentage that your debt payments are to your total income, right? So let's just break it down real quick one more time because this took me forever to understand. Let's say you make $1,000. Well, after you add your house payment, you need to make sure that everything, all your expenses are no more than $450, just to break it down. Okay, now let's go back to finding that first property. Do not max out the amount of home that you can buy. The reason I say this is there's going to be rainy days. You actually want to be able to borrow against your home if you want to do investing or you have an expense that comes up. Whenever you're maxed out, you actually can't borrow anymore. So, for example, we bought a house that was $170,000, and the most we could afford was $230,000. That allowed us to be able to do a HELOC and make investments and pivot into another house shortly after. We bought that house at 195 actually after the first time home buyer fee, which I did a first time home buyer, she did a first time home buyer. Do it separate if you can. That way y'all both aren't maxed out. If you got a partner, y'all do a first time home buyer, the other do a first time home buyer. With the first time home buyer program, you actually can do zero down. It's excellent.
That's a hack.
That's a hack.
Yeah.
Pinnacle Finance Bank, they do it. Pinnacle Financial Partners. Redstone does a first time home buyer program. You want to find an institution that has that first time home buyer program. With that, like I said, your partner buys 1-0 down, you buy 1-0 down. Now you move out, and I think there's a time frame before you can move out. Do your research on that.
Yeah, I think it's like a year, maybe.
Yeah, something like that. But what we did is I did one shortly after we moved into mine, and then we started renting out the other one by the bedroom, making some good cash flow. And then we moved into a house that we turned from a 4.2 to a 5.3. We lived in the downstairs unit, and then we rented out the upstairs, and we made really good cash flow on that. We used that cash flow to get into some investor loans. These investor loans are what I'm going to talk about in the next video. I just want to kind of cover a couple more points on buying your first house, tips and tricks. So debt to income ratio honestly is the most important thing. I'll be honest, credit's pretty easy to get where you need to go. If you got things like collections on your credit report, don't go to the first credit repair company that you see online. A lot of them are going to charge you a lot of money. I charge $50 a month. Super straightforward. You're going to save a lot of money if you do want to work with me. Straightforward. And if you just want some tips, I'm not going to try to charge you if you just need some help. I have enough money. I don't need to squeeze pennies out of everybody. So yeah, make sure that your credit is decent. For the first time home buyer program, you need to make sure that your credit is a 650 or higher. If you're doing FHA, which is a Federal Housing Administration loan, you need to make sure that your credit is 580 or higher. They do go below, but it's your fees and everything are going to be really high for that. If you're doing conventional, non first time home buyer program loan, a lot of the times you're going to have to pay something called PMI or private mortgage insurance. With that, you have to pay a monthly fee if your down payment is less than 20% of the home. FHA loan, your down payment is 3.5%. On a $200,000 house, it'd be around $7K, give or take. You can actually have a family member do something called a gift to you, so gift funds. You just have to write that in a note. So you can actually buy a house zero down with less than a 650.
Oh,
Yeah, and then there's something called closing costs. Closing costs are 3 to 6% of the price of the home. You can either finance the closing costs with the bank and do zero down still, which is just the realtor fees, inspection fees, all that, or you could have the seller cover closing costs. What that does is it makes your offer less attractive. You want to have an attractive offer. We are in a market that's becoming more of a buyer's market. It was a seller's market for a while. What I mean for that is that sellers had the advantage. There was more demand. There's less demand now. It's more of a buyer's market. The buyer, we have more negotiating power now. If you're really looking for a killer deal, you want to go on the filters and you want to type in on either Redfin or Zillow. Best thing to do is ask around, get off market deals. But if this is your first home, probably not doing that. Anyways, you want to look for houses that have been on the market for 30 days or more. The reason I say that is because the person that's holding that, they're really trying to get rid of that. They're being hit with a payment every month. If it's been on there for 30 days or more, you have more negotiating power. You can hit them with a low ball offer. Just sit on it for a while, 10 days or so. And then if they don't get back to you, have your agent call and ask them if they've seen it. Ask them if they were willing to do a counter offer. And then from there, they're probably going to counter offer. So for example, we had a property that we bought, investment property. They listed it for 138. We offered around 120, if I'm not mistaken. And then they actually lowered the price down on the market to 125. Then we came up and met them at 125 because we knew that it wouldn't last for that long. But yeah, if this is your first house, you just want to make sure that your credit score, if you're doing FHA, which I don't recommend doing, is above 580. If you want to do the first time home buyer loan, you need a 650 or higher. If you get into the 700s, your total interest actually starts becoming lower and you save money every month, which is honestly what I recommend doing. But yeah, that's what you want to do. Make sure your DTI isn't too high. Make sure that your credit score is solid. It's really not hard. You kind of just got to take that leap of faith. If you're paying rent, paying 100% interest, you're not building wealth. You're not building equity. I think that buying a home is the right thing to do in most situations if you can. But yeah, next video I'm going to talk about how to buy your first investment property.